you've got valuations pretty high, right? We're in rarefied air here, so I'm not sure if we're underplaying anything at the moment. People are trying to figure out what does it all mean and where do you place your bets. Productivity growth is a critical, long leading indicator of economic activity. So if you have an argument that in the next several quarters you're going to see higher productivity growth, by all means, you know which way you're going to lean on that one driver of cyclical growth. The key is there's no holy grail. You got to look at a bunch of stuff, and that's what our long leading indicator does, and it's firming. And then we talked about our sector indicators. They're generally firming. We talked about our global industrial growth indicators. Those are bottoming out and starting to firm. So you've got a situation where the inflation cycle, the spiral, that bogeyman that we talked about back in July, it's not showing up at the moment, not for the next couple quarters anyway. UK might be an exception. There's actually a little bit of problems there. But writ large, no. And on growth, firming. So I'm actually, it's not that I would take this from the headlines, but on a cyclical basis, you're kind of edging a little bit back towards Goldilocks. You're edging back there. And we were there, remember, we nailed it in Q4 2024.
What do you think? It seems like the labor market is now more front and center for this Federal Reserve than inflation, as you suggested. What's your view of the labor market these days?
Well, it's cooling.
Okay.
And we've been nailing that, but you don't have the recessionary firing, the layoffs. Mm-hmm. Very difficult for companies to get there. So they're looking at their labor pool and managing it as best they can. So you're not seeing mass firings. Look, the AI stuff is going to obviously get in there. I think another component of what's confusing is the K-shaped nature of consumption. Yep. So the wealth effect is in full effect. If you have share prices, if you have investments or home, you have some feeling of a wealth effect, which is boosting your overall look on spending. If you don't have that, if you're paycheck to paycheck, which is the majority of people, you're living a very different experience, and you're under a lot of pressure. So
how long has that K-shaped economy been with us? I mean, it seems like kind of forever. Maybe it just gets more pronounced when stock market's ripping, real estate's ripping. It just becomes more pronounced, I guess. I don't know.
Well, so that's one component. That's lifting the upper part of the K. The other thing is when job growth slows, when the market gets a little weaker on the job sector, then the lower end of the K comes under more pressure. So that gap can feel more intense, and that's what's going on. You're right. It's kind of a plutonomy in a way that we're dealing with.
What is a key distinction of your cycles right now? Page 1, page 2, page 6 of your research note. What's the one chart, and I'm going to say almost the tangent of the movement of the cycles?
Look, I think
right now, what's the key point?
Yeah, look, the key point is inflation. I think that's the thing that people have a very tough time understanding, and if you're getting the direction on that correct, it helps you because that's so critical for pricing pretty much everything. And here, the future inflation gauge, and Tom, I'll go all the way back in the annals of your brain there and go to Greenspan in the circa 1990s. This is the indicator that gets you on the right direction.
Right.
Okay, and that is not running away, and that is what you need to know.